Hi, and welcome to Chapter 13. Today we're going to talk about investing in bonds and other alternatives. Our learning objectives today are investing in bonds, understanding basic bond terminology and the different types of bonds, calculating the value of bonds, understanding how the value of bonds change, comparing preferred stock to bonds, understanding the risks associated with investing in real estate, and knowing why you shouldn't invest in gold and silver and gems and collectibles 100% of the time. So I wouldn't say you should always not invest in these commodities, but there's a limited upside compared to some other investments, and we'll talk about that later. So first, let's talk about bonds. As an asset class, bonds are less riskier than stocks. If you look at maybe not on a yearly basis, but on certainly on a 5, 10, 20-year basis, bonds have less risk than stocks. There are rare occurrences when interest rates move up quickly that bonds can have enhanced risk. But the nice thing about bonds is it provides a steady stream of income for investors. Um, so returns on bonds can be, in some years, can be quite large, even double-digit returns. Now, bonds are part of your diversification strategy. So bonds can reduce risk by diversifying them with stocks. So instead of including 100% in your portfolio in stocks, you want to include some percentage in bonds. Now, this percentage of bonds grows larger as you get closer to retirement. And since they produce a steady income, the income can be reinvested in bonds or can be used for income when you retire. Now, the nice thing about bonds is if you buy a bond at, say, $1,000 the day the bond is born, that price of the bond can fluctuate, go up to 1,400, down to 600, down, back up to 1,100, down to 800. But if you hold the bond to maturity, you're going to get the full amount principal back. So let's talk about some basic terminology. Par value. So the par value is very important in bonds. This is the face value of the bond, or the amount that you're going to get returned to you at maturity. So basically the bond is born at the par value and it dies at the par value, and then it trades at all different values during its life as it adjusts to changes in interest rates. So the maturity is the length of time the bond has until it matures, until it reaches the par value to pay back to investors. So you can look at maturity as, you can say when the bond is first born, it's a 30-year bond, it's a 10-year bond. But, if you have a 10-year bond and it's 6 years into the 10-year bond, it will mature in 4 years. Now, coupon interest rate indicates that if you take the interest rate times the par value, this will be the amount of interest you earn on the bond. Now, the par value is the amount the bond it was created at. And typically bonds are created at a par value of $1,000. So if you have an 8% interest rate, you're going to get $80 annually. And if it's a semi-annual bond like uh, insurance protection bonds, you're going to get them every $40 every 6 months. Now, why do they call it coupon rate or coupon interest rate? Because there was a point in the past before computers that you bought a bond, you were given a coupon book, and you'd rip out the coupon each month, each time it was due, and you'd go to the bank, and they would pay you the interest on that bond. Okay, so what's continuing with the basic terminology, indenture. So an indenture is a legal document that's going to provide specific terms of the loan agreement, including description of the bond, the rights of the bondholder, the rights of the issuing firm, and the responsibility of the bond trustees. So bond trustee usually is a banking institution or trust company that's assigned the task of overseeing the relationship between the bondholder and the issuing firm. So a bond indenture may run over 100 pages in length, with the majority devoted to defining the protective provisions to the bondholder. So basically, it's like a contract. So when you buy a bond, this well thought out, well established contract that is reused like a boilerplate many times over for different types of bonds. And it's just really to really iron out all of the legal details of the bond. Now, a call provision. So some bonds can think of bonds like a product. And this product can have all different features, just like when you buy a car, it can have all different features, and you kind of, need to know the terminology of different features. So bonds with a call provision, this is going to give the bondholder the uh, some advanced information about how the bond can be recalled. So the company or the government that issues the bond, they may want to repurchase, or what we commonly call the bond. Like you ring in the telephone and you call the bond up, hey, come on over, and that's a repurchase. So why would someone want to repurchase the bond from the shareholders? Um, well, they may want to repurchase because they want to refinance. So the bond might have been issued at 10 interest rate at 10%, and now the going rate's 5%. They'll call the bond, they'll pay you the par value, and then they'll just reissue the debt at a lower interest rate. So it's a commonality with bonds that they're going to want to repurchase if it's going to make sense to them. So a call provision works to the disadvantage of the investor. So bonds with a call provision generally pay higher rates of return as compensation for the fact that the bond can be called and repurchased at any time, and you could lose higher interest rates if interest rates go lower. So now to make callable bonds more attractive, the issuer um, includes in the indenture some protection against calls. Generally, that the call protections come in the form as a deferred call. So that means the bond can't be called until a set number of years have passed. The bond is issued. So it might be that we're going to issue a 30-year bond, but we can't call it in the first 10 years. That's pretty common. So just give you a little more protection from it being called right away. Now, there's also something called a sinking fund. So no one likes the debt to be paid off all at once. Um, and that goes for the bond issuers too. So most regularly, they set aside money in a sinking fund to pay off the bond at maturity. So with the sinking fund, each year the firm calls some of the outstanding bonds using the call provision, repurchases some of the open market. So in this way, the issue spreads out the large payments that would otherwise be occurring at maturity. So a sinking fund is a way to, instead of paying all the money up front at the end, to slowly pay off the bond and mature or call part of the outstanding bonds um, at a time. So it might be, $1 million bond. They issued $1,000 bonds, and they're slowly um, repurchasing them along the way. And with the sinking fund for investors, you have a greater chance that the bond will be paid off without any risk of unpayment. Okay, so let's talk about different types of bonds. So the three most common types of bonds are corporate, government, state, and local bonds. So a corporate bond is issued by a company. So a company has a choice. We can go public and issue shares of stock to raise money, but we're trading ownership for those shares of stock, or we can decide to issue bonds, and that way we're not selling any ownership of the company. We are just borrowing money that we're going to pay back with interest. So this is a major source of funding for corporations, um, and it probably accounts for close to half the bonds outstanding. And corporate bonds are generally issued in the same $1,000 denomination, so the par value is $1,000 per bond issued. Now, is corporate debt secured or unsecured? Well, they could be both. So a secured bond is one that's backed by some sort of collateral, like the assets of the company or the assets of equipment. So if they don't pay the bond, you're going to be able to capture the assets and sell them for collateral. Now, a mortgage bond is going to be secured by real estate property. So a mortgage bond is specifically secured by a real estate, a building, a land, things of that nature to give you additional protection that the bond will be satisfied if the company goes bankrupt or is not able to pay. They can use the land or the building as collateral. Now, unsecured debt, this is a debenture that is, not going to be secured by assets, the business, or land. So it's really just secured by the good faith and the financial stability of the company. Um, so it's riskier because it's unsecured, and they usually have a higher rate of interest. But for companies that are very, if you get a bond from Apple Corporation, that's not going to be um, terribly risky because the company has a good track record. It has a huge amount of profits in cash. So it depends on the company as far as the risk level. Now, if we're looking at Treasury and agency bonds, some of these are risk free. They're not callable, but they're going to pay a much lower interest rate. So you get a lot less risk and a lot less interest rate. Um, Now, some of these bonds are exempt from state and local taxes. So if you have, the reason for this is the US government issues a treasury bond. The US government can tax it, and they do tax it, but they don't want states to tax the federal bonds because states could, if they did that, states could have more power over the US government and they could basically tax these government bonds so much that nobody would buy them. And it's the same thing. So when states or local municipalities issue municipal bonds, the federal government won't charge tax on them because they don't want the federal government to interfere with the state's ability to raise money. Now, let's see here. Okay, just going back just to kind of see what we're. All right, so treasury bonds, treasury debt can have a maturity anywhere from 3 months to 10 years. And treasury bills, notes, and bonds offer different maturities and denominations. So treasuries are US government bonds that are issued from the government, and they issue them in short, medium, and long-term platforms. So it could be a 6 month, a year, a 10-year bond, a 30-year bond. So, and this is issued directly from the US government. Now, an agency bond has an affiliation with the US government. So it's a US government agency that issues the bond, sort of like Fannie Mae or Freddie Mac, um, federal home loan banks. They're agencies of the government that have the ability to issue bonds as well. Uh, so there's a lot of bonds issued between states, federal government, and government agencies. A lot of money is raised through these different bonds. Now, a pass-through certificate um, of these agency securities, the most probably interesting or demanded by investors would be we call the Government National Mortgage Association, or um, sometimes referred to as Ginnie Mae, and it's a pass-through certificate. So the Ginnie Mae represents interest in the pool of federally insured mortgages, and the package is a group of mortgages, securitizes a group of mortgages worth usually $1 million or more, and then sells them into denominations of $25. So the pass-through certificate is basically passing mortgages through to raise financing. So the government likes to be able to facilitate the size of the mortgage industry, the mortgage market, especially for lower income individuals, and just make sure there's a lot of ability for the um, for the mortgage market to operate and mortgages to be established. So they can repackage these mortgages and sell them to investors, thereby getting more mortgage money to give to other people. This is the same thing that commercial banks will do as well. They will sell their mortgages to a mortgage securitization, and they'll call them mortgage-backed security, and those will be sold to investors. But those are non-government related. It is also what created the real estate bust and the um, financial turmoil of the 2007-2008. Now, another treasury that's a very interesting, especially in times of inflation, are what we call TIPS, Treasury Inflation Protected Securities. So these are new to the family of treasuries. But they've been around for a while. but they're new. Treasuries have been around for a lot longer, but TIPS are sort of new. So these bonds are going to have, of course, another range of maturities, 5, 10, 20 years, with typically par value of $1,000. But what's interesting about these bonds is when there's changes in inflation, which is measured through the consumer price index, there's going to be a change in the um, value of the interest that the bond can pay. So, say there is um, a 3% increase in the inflation or the consumer price index. So, the par value of the bond will go up by 3% from 1,000 to 1,030. That means $1,000.30. That means that you'll get a little bit more interest each year, and at maturity, you'll get a new par value. And that's because the interest payments are then determined by using the new par value. So the par value rises to 1,030, and the interest in the bond is set to 3.8%. So now you get 3.8%, which is about $39 a year. And then when the bond matures, it's going to pay you $1,030. So what's nice about this is that it protects you from inflation. Um, so these are really nice bonds to have if you're worried about inflation eating away at your money. And there's also the US series double E bonds and I bonds. So the double E bonds, um, these are more for smaller investors. So these double E bonds are issued by the Treasury with fixed interest rates and denominations um, so low they can be purchased for as little as $25 each. So these are sold electronically, and these are meant for very small investors that don't have $1,000 to invest in a bond. That can buy bonds at much smaller bond prices. Now the I bond is is another type of bond in the double E series of bonds. So this is Treasury issued I bonds, and the I bonds have an accrual type bond, so meaning that the interest is added to the value of the bond and paid when the bond is cashed in. So, like TIPS, these bonds are sold at a face value and grow with inflation earnings for up to 30 years. So the return on the I bond is a combination of um, the fixed rate of interest and then a semi-annual inflation rate. So the inflation is calculated and added to the payment of the I bond. Um, so you get that fixed rate of interest plus additional amount of money for inflation. Um, Now with the I bonds, you can invest as little as $50 or as much as $10,000 per year. So they have a tax advantage as well. So allow you to defer, federal taxes on earnings for up to 30 years, and you're exempt from state and local taxes. In addition, these bonds are very liquid and can be turned over to cash um, pretty quickly. Now let's talk about municipal bonds. These are the bonds that are usually the most tax-free. So these can be issued by states, counties, cities, public agencies, school districts. Um, so there's a lot of these bonds, and there could be just every state has many types of municipal bonds, and it's a multi-trillion-dollar market. And it's very popular because they're tax exempt, and generally they're tax exempt from federal and state taxes, as long as you live in the state that the bond is issued. So if you live in New York and you buy a New York municipal bond, you won't pay New York tax or federal tax. And if you live in the city, New York City, and it's a New York City municipal bond, you won't pay city, state, or federal tax on the bond, which is very attractive. Now, there are two basic types of municipal bonds. You have the general obligation bond, which is backed by the strength of the taxing power of the issuing body. So if it's a state, it's being backed by the full faith the state is going to honor their commitment to their municipal bond and pay it back. Now, a revenue bond is a different type of municipal bond where they can pay interest and repay the bond, and it can be set or connected to a specific project, like a toll bridge or stadium. So if the revenue is generated, when the project generates revenue, um, it's going to be exempt from the state and local taxes, but not federal taxes. So revenue bonds are a different type of bonds. So it can, um, they're a little bit more secure because they have a revenue source to back them up. So even if the state has financial trouble, these bonds will have an additional revenue source. Um, but it has a downside where it's not generally federally tax free because of the revenue generation portion of it. Okay. Now, serial maturities. So this may be a bond that has different maturity dates. So in fact, the municipal bond is, when we say serial, that means a continuing event. So portion of the bond comes due and matures each year until the issue is exhausted. So it's sort of like a sinking fund when we talked about the sinking fund in corporate bonds. And, because they're backed by governments, they are low risk, but they're not completely risk free. There have been instances where local governments and counties have defaulted on municipal bonds and had bankruptcies. Some of the big ones, I think Puerto Rico had defaulted on some bonds. There's Orange County and Chicago and Detroit. So this is generally not a good thing when these bonds, when bankruptcy occurs to a county or city that's just really bad financial shape. Generally, they do work to repackage or refinance and get this money back to investors at some point. So hopefully the defaults are just temporary. But municipal bonds are a good, safe way to, if say you have a high income, in the years you have a high income and you have some money that you need to park for a short period of time, or you just don't want to invest it in stocks because things, you're just not ready for that right now. You can park them in municipal bonds and then get this, tax-free income. And since you're in a high income bracket, the tax-free is even more valuable. Now, zero coupon bonds, these are bonds that are not going to pay any interest. So zero coupons means zero interest, but they're sold at a very deep discount. So with a zero coupon bond, these are sometimes like, saving bonds. You could buy it for $50, and then when it matures, they'll give you $100. So you basically buy the bond at a real discount, and then when the bond matures, you get much more. So it's I think saving bonds are pretty common for this. Now, junk bonds. Um, Junk bonds is what typically was called in the 80s, but then in the 90s they started calling them high yield bonds because no one wants to think of themselves as buying junk. So junk bonds change your name to high yield bonds, which are bonds that have lower overall ratings for corporation, for anything really, but it could be municipals, it could be, but typically it's mostly corporations that have the lower bond ratings. So it's just riskier bonds that are attached to companies that might have financial issues and suffering from poor credit. So if they issue bonds to finance the company, they have to pay more interest. So junk bonds, of course, carry a lot more risk, but they carry a lot more potential return. So, a highly rated A or double A bond, you might pay 4% return, while a junk bond can pay 6 or 7% return. And an extra return is to make up for the fact that the the bond could just not be paid back because the company's risky. And generally, junk bonds, if the company starts doing better and their credit position improves, they're more likely to be callable as they refinance for lower debt. Now, how do we rate bonds? Well, we use usually a letter system, like sort of like grades in the class, and we have these independent companies like Moody's and Standard & Poor's are the two biggest that are going to employ people who are going to review and determine the rating on both corporate, government, and municipal bonds. Not so much federal treasuries because they're just considered risk-free and pretty safe, but they do grade those as well, but they don't change very often. Although a few years ago, the U.S. government treasuries went from the strongest rating possible to one below that, and that, from a triple A to a double A, and that was big news, but didn't really have too much effect on the bonds. Now, the these rating agencies are going to judge the potential risks and future of the bonds and give them a rating. So this is how we determine what's investment grade, what's speculative, what's junk bonds. So the poorer the rating, the higher the interest rates the investors are going to have to pay. So, you know, just like in class, you don't want to get a D in class. It's very risky. You're going to pay very high interest rates, but you want to get that A. And the A is, it could be, triple A, which is prime, double A, which is very strong, or just A, which is strong. So this is, pretty easy to follow. But there was some problems in, 2005, 6, and 7, where these bond rating agencies were rating mortgage-backed securities as very, very strong, or prime ratings for bonds, and they just didn't do their homework, and these were much riskier bonds than they were rated. And some of them, there were a lot of defaults in these packages of mortgages, as mortgages were not really being vetted properly. And there was some problem with collusion. Some of these rating companies had economic involvement in some corporations, which pressured them to give these corporations better bond ratings than they should have gotten. So, but this was typically cleared up after that, after this was discovered, and now these bond ratings are considered a lot more realistic. And this is a chart of the ratings, and the two companies have different but very similar ratings. One uses just all upper cases, and one uses upper and lower cases. So, but very similar. Okay, so current yield. Very simple here. Take the annual interest payments divided by the market price of the bonds, you get the current yield. Yield to maturity is a little bit different, where we're going to take the annual interest payments and we're going to add that to the par value minus the current price divided by the number of years of maturity. Then we're going to divide that by the par value plus the current price divided by 2. And this is going to be approximate yield to maturity. So, neither of these formulas are that complex. It's really just a matter of following the order of operations. So, municipal bonds, since they are tax exempt, we have a formula to calculate the equivalent taxable bond value. So what that basically means, if you have a corporate bond at 10% and you have a municipal at 6%, are they equal if you factor in the tax-free status? So to calculate the equivalent taxable yield, basically converting a municipal tax-exempt bond to a tax bond as far as the return, we take the tax-free rate in the municipal and we divide by 1 minus the investor's marginal tax bracket. Okay. So remember some basic bond principles. We refreshed your memory on time value of money in an earlier chapter of this course, and the time value of money is also covered in the investments class, in the finance class, in the accounting class. So it's something that you know pretty well. But this is how we value bonds, is we use time value of money. But we also have to factor in risk. So risk, the time, the value of money, and the risk and the bonds is how we basically calculate the dollars of interest payments and principal values together to determine what's the overall price the bond should be today, or what's the fair price of the bond. So the value of the bond is basically a present value problem. So we're looking at the present value of the future interest payments and the present value of the repayment of the bond's par value. So if you add these together, the present value of the interest payments plus the present value of the repayment of the par, this gives you the current value of the bond today. And that's, so bond valuation is a lot easier than stock valuation, because you got this, we have a formula to calculate it that's very accurate. Now, if the corporate bond issuer becomes riskier and the chances of default are greater, the required rate of return on these bonds are going to rise. And that's to compensate investors for these new risks. And generally how that works is the value, the current market value of the bond drops. So it's going to pay the same amount of interest every 6 months, but what it costs to buy the bond is less. Instead of paying $1,000, you may only now have to pay $800. So in the beginning, you paid $1,000 to get an 8% coupon or $80 a year. The bond became riskier, so it devalued. The par value is no longer the par value is always at 1,000, but the market value may go down to 800, thereby pushing up the return to 10%. If you take $80 divided by 800, the return on that bond is now 10%, and that's to compensate new investors due to the riskiness. If you currently own the bond and the corporation gets riskier, you lose. Basically, if you sold the bond today, you would lose that $200 difference between the par value and the market value. So when interest rates rise, the outstanding value of bonds typically fall. So there's an inverse relationship between interest rates and bonds. So this is so critically key to this whole chapter. Interest rates go up, bond values go down. Interest rates go down, bond values go up. So uh, why is this? Because if interest rates go up, your bond is old and busted and no one wants it. So interest rates now are 10%, your bond is only paying 7%. Who would ever want to buy that bond? They wouldn't. So it has to go on sale, on discount. So it gets discounted enough to make the interest equal to the going rate of the market interest. And that's why bond prices fluctuate. But you can always wait it out. If you just wait to the maturity of the bond, it's going to always pay the par value. So even though the value of the bond, market value of the bond may change as it's going through the life of that bond, but at the very end of that bond, it has to pay the par value back. So it's a temporary dip but bonds can also appreciate. If interest rates go down and the new bonds are paying 3% and you have a 6% bond, it might be trading at $1,200 instead of $1,000 to realize that your bond is paying more interest. And that might be a good time to sell that bond and get that capital appreciation in that bond. So longer term bonds are going to fluctuate a lot more than shorter term bonds. So it's sort of like a whip. If you try to snap a whip, the part of the whip closest to you moves the least, and the part of the whip that's farthest away from you moves the most. So that's the same thing with how bonds fluctuate. So here's the relationship we could look at. Here's the bond prices in blue and the bond yields in green. So as the bond yields go up, bond prices go down. And as bond prices go up, the bond yields are going down. So that's the inverse relationship. Now, let's look at the relationship between the length of the bond's maturity and the amount of price fluctuation. So if the bond's going to mature in a year, very little price fluctuation when interest rates rise or decline by 1%. In 3 years, it's greater. 10 years is greater. And in a 30-year bond, so if the bond has 30 years for the life of the bond and there's a change in interest rates, the overall premium of that bond, the amount of that bond will fluctuate the greatest, just like that whip effect I had talked about. And it's because you have many more years of earning interest at either below market rate or above market rate, which is going to affect the overall price fluctuation of the bond. So as bonds approach that maturity, though, the bond's going to get closer to the par value. So when interest rates go down, bond prices go up, but upward price movement of bonds with the call provision is limited by the call price. So let's just look at this chart here. It's a very classic chart that we want to talk about. So here we have out here we have 5 years until maturity. Here we have 0 years. So at the 0 year, the bond is going to pay $1,000. That's the par value of the bond at maturity. But if it's 5 years from maturity, and the bond value has a required rate of return at 12%, or this could say the coupon is 12%. If interest rates go up to 15%, so new bonds, the interest rates are going up to 15%, your bond has to be discounted. No longer will sell at 1,000, will sell at $8.99. And say interest rates stay that way at 15%. As your bond approaches maturity, it's going to slowly gravitate back towards that par value because this is what gets paid out at maturity. So the effect of the change in overall value of the market value of the bond, when I say market value of the bond, that's the value you can buy and sell the bond at. Now, if interest rates go down, so your bond pays 12%, but the current bonds are paying 9%, your bond's going to sell at a premium. And the premium is greatest the further away from maturity. And as we get close to maturity, that premium is almost unnoticeable. So let's look at some pros and cons of investing in bonds. So The big benefits are if interest rates drop, bond prices go up. So we like to own bonds when interest rates are going down. Bonds reduce the risk through diversification, so it can help reduce the overall risk of your portfolio if you mix it with stocks. There's a steady stream of income and can be a safe investment if you hold them to maturity. The dangers of bonds are if interest rates rise, bonds are going to have a horrible year. If there's financial problems of the underlying government or corporation issue the bond values can drop as the the risks increase. If the interest rates drop, it might become an attractive target to repurchase the bonds early, and it's going to lower your overall return of interest. Um, so if you have to sell the bond early, you might have to sell at a discount. Uh, okay. So what bond valuation relationships mean to the investor? So if you expect interest rates to go up, bond prices will fall, you should be having your money in more short-term bonds, and this will help protect your money. But if you expect interest rates to go down, you should move your money into longer-term maturities that are not callable. So there's a lot of bond strategies as far as how to invest in a portfolio of bonds. There's ladders, there's staggered purchases and sales. But a bond fund manager can pursue these strategies a lot easier than an individual. So individuals usually just typically buy the bond and hold it, but bonds can be sold in a mutual fund or an ETF, and the bond managers may have a little bit more leeway of buying and selling or moving bonds between maturities. Um, okay, so what should you think about when you want to buy a bond or pick a bond? Well, you want to think of the effect on taxes. If you're in a high tax bracket, you may want to consider a municipal bond. You want to look at how reactive the bond is going to be to interest rates. If you're going to buy a corporate bond, you want to stick to companies that have the best chance of being successful in the future. So you don't want to really get involved with companies that are likely to have financial struggles. You want to, in that way, I would say only to buy bonds with A-level status. Uh, I would say single A, double A, or triple A. Here it's just saying triple A or above, but I'd say any bond with an A status is pretty safe. Um, it's nice to get the bond when it's issued in the primary market rather than the secondary market. So you get that, you know what you're paying, that par value, and then you can retire at par value and you lose no principal. You want to know what the callability of your bond is, and you want to avoid bonds that are more likely to get called. Um, Match the bond to your investment horizon. So if you're going to retire in 30 years, probably today is a good point to buy 30-year bonds. The larger issues are generally better as far as liquidity. And if you're really not sure what bond to buy, just buy a Treasury. They're probably the safest and less likely to lose any type of money. So now, reading a bond quote, they're quoted as percentage of the par. So this is a little different than stock. So if it's $1,000 bond, it might be quoted at 99, 98, or 90, which means it's 90% of the par. It could be quoted at 105, 110. So a $1,000 bond quoted at 110 is $1,100, or 110% of the par value. If it's quoted at 90, the $1,000 bond selling at 90 or 90% of the par. Um, Now, with corporate bonds, if they accrue any interest, they're gonna generally pay that accrued interest. So the sum of the quoted or stated bond price and the bond's accrued interest will be found in the secondary market quote. So here's a quote. It's harder to get bond quotes than it is to get stock quotes are everywhere, but bond quotes are a little bit more difficult to get, but you can still get them from many different sources on the web. So we do have the issuer, the company that's issuing the bond. We have the coupon rate, which is the amount of money the bond will pay against its par, the date it matures, the rating, the price of the bond. So this bond is 105.52%. So if it's $1,000 bond, it's going to be trading at $1,555.20. This is the change for the day, the yield to maturity. So since the bond is trading at a premium, the coupon rate is divided by the premium, and the actual yield to maturity is a little bit lower because the bond price is higher. And then we can also calculate the current yield, which is the return just from interest. It's the annualized divided by the price of the bond. Oh, this is what I was talking about before. This current interest is the um, the interest paid, which would be um, $56 here divided by the price. That's the current yield. The yield to maturity, sorry, I messed this up before. This is, we have to factor in the par value because that's the maturity value. So we're looking at the par value. So it would be the actual uh, rate of return uh, if they hold it to maturity. So we'd take the current value of the bond, um, and we want to look at the capital gain or loss resulting from buying or selling the bond. So it would be a combination. Here we have a loss because we're buying the bond at 105 and we're going to be selling it at maturity at 100. So that loss of $5 of capital from buying it at a premium is going to lower the effective coupon rate to 5.25%. And then we'll tell you whether it's callable or not. Now let's move into preferred stock. So last chapter we talked about stock. I had mentioned preferred stock. However, preferred stock is more like a bond. It's a hybrid between a stock and a bond. So it's similar to a stock that there's no maturity date, and that's the biggest difference. A stock has no maturity date. A preferred stock has no maturity date, but a bond does have a maturity date. Now, these preferred stocks also have dividends that are stated and that the company is going to pay. So it has like a stated continuous dividend. Now, similar to bonds, uh, the dividends are fixed. So typically preferred stock, the dividends are not variable, they're fixed, and they're paid before any common stock dividends are paid. So they have a priority. That's why they're preferred, because they get paid their dividends first, and then if any money's left over, then common stock can get paid a dividend. But preferred stocks generally have no voting rights. And preferred stocks, the stock price of preferred stocks is generally much less volatile than the common stock because they have this income component that helps stabilize the price of the preferred stock. Now, so preferred stock does have a number of features, multiple issues. So a firm can issue more than one series of preferred stock, so it can issue multiple groupings of preferred stock over time. Preferred stock carries a cumulative feature, so that requires any unpaid preferred stock dividends accrue, and they're going to be paid out at a future date. So if they miss a payment or they just can't afford to make the preferred stock payment, it's going to accumulate, and these have to be paid before any common stock dividends get paid. Now, adjustable rate preferred stock, even though before I said that that was really not a thing, it's really not very common, but they can have preferred stock that does have some sort of adjustable rate written into the contract. It's just not that common. Now, a nice feature of a preferred stock, and Amazon issued a lot of this actually, is convertibility, where you can take preferred stock, convert it into stock. So, and there's usually a predetermined exchange rate. So, one share preferred will convert to two shares of common, as an example. So, this gives you the right at a certain point, if you're owning preferred stock, and it gets to a point where, say, you bought the preferred stock at $50 a share, when Amazon's common stock was $20 a share. And it gave you the right to convert your one share preferred into two shares of Amazon stock. Now Amazon stock's at $1,000. That would be a good opportunity to convert because you're able to take advantage of the growth of the common shares by converting your preferred stock into common stock. However, if you get this convertible feature on your preferred stock, the dividends are going to be much lower because it has this extra feature. They don't have to pay as much in dividends, and that's why they would give you this convertibility rate, is to give you a lower dividend rate on the preferred stock. Now, preferred stocks can also be called. So if the company decides to eliminate the preferred stock for any reason, they can call it and buy it back from you. And now, since preferred stock doesn't have a maturity date, generally companies after a certain period of time, if they become very wealthy, they're going to look at preferred stock and say, okay, we have enough money, let's buy back all that preferred stock and end that obligation. Now, valuation of preferred stock is pretty simple. We just take the annual preferred dividends and divide it by the required rate of return. And this will be the value of the preferred stock. Um, and the value of preferred stock does change, and it moves in the opposite manner of interest rates, just like bonds. So some risks associated with preferred stocks. Of course, if interest rates drop, the value of the preferred stock will be um, if interest rates drop, the value of the preferred stock will be better. If interest rates rise, the value of the preferred stock will drop. So if we have preferred stock, we want interest rates to go down. We'll make our preferred stock more valuable, but we don't want to make it so valuable that the company calls it to reissue it at a lower interest rate. So investors are generally don't participate in much of capital gains because the preferred stock doesn't change its value too much in relationship to the value of the company unless it's convertible. Otherwise, the value of the preferred stock is going to change in relationship to the change in interest rates. So there's going to be very little capital gain to be made with preferred stock. Um, but investors don't have the safety of bond interest payments because preferred dividends can be um, passed over without the risk of bankruptcy. So you have less guarantees of this interest being paid out with preferred stock. And that's why preferred stock really isn't that common or that big of in the marketplace. It exists. Some companies use it, but it's a fraction of the total amount of the total bond market. And it's a fraction of the total stock market. Let's switch gears into an alternative investment, real estate. So investing in real estate is generally a good idea, and most Americans um, have investments in real estate, and they may have a lot more money invested in real estate than they do in stocks and bonds, and they generally have a pretty decent return on real estate because it's very rare. It happens, but it's rare that real estate values go down. But real estate usually requires a lot more of your time, energy, um, to be involved with buying real estate. And it's not a very liquid asset. You buy real estate, it takes time to sell it. So you can make direct investments in real estate by just buying a house, or you can make indirect investments in real estate buying a REIT, a real estate investment trust, which you pool your money with other investors, and these can trade like a stock as well. Um, Now, the bottom line, real estate is not well suited to a novice investor. So what we're talking about here is if you don't know what you're doing with real estate, you can get burned. So you do want to put some research and time and energy into it. So now with real estate, most people buy real estate to live in it, and they're not buying it as an investment per se. So if you buy a house to live in, it's not really, I wouldn't say it's not really much of an investment because you're living in it. That's the benefit. But there are a lot of taxes you have to pay, maintenance and repairs, and utilities that, and interest if you have a loan on that house that eat up a lot of the capital appreciation you'll make when you sell it 10 or 20 years later. However, there are some people who will speculate in real estate and they'll go to hot real estate markets and they'll buy up units of real estate, rent them out. After 10 to 20 years, when the real estate doubles or maybe triples, they'll sell them for a huge profit. So it's a very long term type of investment. There can be hot real estate markets where you buy something and within 2 years the value goes up a great deal. But it's very hard, just as hard to time the real estate market as it is to time the stock market. So but the nice thing about real estate is you typically need, you can borrow a lot of the money required to buy real estate. So with stocks, people are usually funding stocks and bonds 100% with their cash. And you can sometimes buy stocks on margin up to 50%. But with a house, you can sometimes buy a house on 98% margin or borrowed dollars. So the down payments are much less with houses. So you can get a lot more leverage with a house, which can accelerate returns. Now, other speculative investing, a lot of times people will talk about investing in gold and silver and other collectibles. Um, Generally, the advice for most people is don't do that. because these are usually non-paying, non-productive assets. So not, if you invest in a stock, the company that the stock is tied to, the company is going to generate profits and generate returns through the business. If you invest in bonds, the bonds are going to generate income through dividends. Use gold and silver don't do that, and gems don't do that. So um, I wouldn't say it's 100% speculation to buy gold or silver. Gold and silver can have their place in an investment portfolio, especially to hedge against inflation or devaluations of currencies. But diamonds and other gems, typically you pay a lot more for them than you could resell them. So you might buy $1,000 diamond, but only be able to resell it for 800. Or you might buy, gold. You're going to get you the middlemen get a lot more money when you try to buy and sell this. Um, but they've made it easier to buy and sell gold through ETFs and mutual funds. So uh, typically gold and silver have a lower return in the long term aspects compared to bonds or stocks. But I would say that there is a place for investing in gold, and generally it's a great hedge against inflation. Now, collectibles, that's not a great investment. Investing in comic books, baseball cards, um, action figures, collective commemorable plates, stamps, coins. This, um, although people can make money in this, it's typically a losing bet. I remember when I was much younger, I had a comic book collection. I thought I was going to become very wealthy on this comic book collection, and I had 8,000 comic books. Of those 8,000 comic books, 7,950 of those comic books were pretty much worthless or worth less than I paid for them. There were 50 or so books that had appreciated greatly in value because they had a key character or the first issue of a new series. But even with that, so say I had a couple comic books that I had that were very valuable. I had the first appearance of Wolverine, the first appearance of Deadpool, the first appearance of Cable. So I had a number of key issues. Um, Maybe the first appearance at the time I sold it, the first appearance of Wolverine was worth $1,000. Nobody would buy it from me for more than 600. So generally, who do you sell these to? You would sell them to a comic book store or another collector. eBay changed that a little bit, it made it a little bit easier to sell your valuable collectibles at closer to market rate, but still you should buy these things for its entertainment or sentimental value. I wouldn't necessarily buy them for an investment. Just look at all those people who bought Beanie Babies. They're all worthless. There's been these trends, Pogs, Beanie Babies, sports cards, comic books have gone bubble to burst, Funko Pop. So those are not investments. Mint in box action figures, just poor investment. Um, don't expect these to provide for your financial future. Just silly. Put your money in stocks and bonds, and you'll do much better. And it'll be a lot less guesswork. Because with these collectibles, you really just never know what's going to be valuable. Okay, a summary on this chapter. Bonds reduce risk through diversification in a portfolio and producing steady income, and can be relatively safe depending on the government or the company you buy them that represents them. Holding bonds to maturity will protect you from any devaluation of the bond, because as it reaches par value, they pay you the actual par value of the bond. The bond value is really a representation of the present value of its future cash flows, which would be interest payments and the par value payment. Preferred stock is a type of stock that's a hybrid where it exists between stock and bonds. There's no fixed maturity like stocks, but it generally pays a set dividend over time. Um, you, Investing in real estate and property uh, can be a good investment. It's a little bit more tricky of investment. It's a little bit more long-term of an investment, and usually does rely. The way the housing market works is you get in a 10-year period, you might have 8 years with no real appreciation, zero appreciation of your home, and then 2 years with a 50% return each year. So it's very unbalanced. It's not something you want to do for short term. Gold and silver can be an investment that does hedge against inflation, but typically these are non-productive assets, meaning that they don't produce anything. Just like if you look at Bitcoin, Bitcoin can kind of, or cryptocurrencies can kind of fit in this category where they're non-productive assets, where they go up in value, but they're not like a business where they generate um, profits and income and dividends, and they're not like a bond that generates dividends. So they're non-productive, which means they generally have less of a return over a long-term period and can be quite speculative. So those are basically investments you can dabble in, but I would put the bulk of your money in stocks and bonds. Um, Okay, so that's been the chapter 13, investing in bonds and other alternative investments. I thank you for your time, and I look forward to talking with you when we move into chapter 14, where we're going to be talking about mutual funds and ETFs. And this is, for most of us, this is where a majority of our money will be invested. Most average investors don't invest in individual stocks. They don't invest in individual bonds. They invest in either an ETF or a mutual fund, which is a grouping of stocks that you can easily purchase under one ticker symbol on the market. Okay, talk to you soon. Take care.